Hello and welcome to today's extensive weekend video, which is going to be about not just the US dollar clear sign that we are seeing on the charts, but it will be, as always, covering yields, equities, gold, silver, oil. We will dive into cryptos. I will present what I see unfolding in equities going forward. We will go through the sectoral analysis. And this presentation has your chart requests, so stay the course. This is going to be packed with a lot of information, and it's going to be tied as well to preceding videos made not just during this week. Thank you for liking this video and subscribing to the channel. Incredibly, over 2/3 of you who are regularly visiting are not subscribed, so make sure you get the notification on so as to see right away when new content is being uploaded. It's always pre-market, and I take care for the daily videos not to exceed 10 minutes so that you have ample time to translate that into your own trading and get ready for the day ahead. As always, let's start with yields. Following Thursday's call at Davos for lower rates worldwide, we had not seen these really retreating, and the data incoming events had been favoring such a retreat. And you see barely dipping on the short end and barely noticeably declining on the long end as well. It's that services PMI came more than a couple points below expectations. It's no longer 56 but rather 52 only, which signifies a slowdown in the rate of expansion. And the factor that I had been talking for such a long time, the ascent in US dollar, which had been together with rising cryptos and select IGV performance doing well within this sector. Forget not about industrials. These have been as well a cornerstone of my bullish calls at the election time. These had been having fine moments, and now let's check as well upon the consumer sentiment, which had been revised lower. So the strengthening dollar is catching up not just with the periphery, but it's starting to affect the US economy as well. And don't count on the manufacturing PMI going barely positive to turn the ship around, because US economy is predominantly about services. So we had seen yields not going pretty much anywhere. You remember as well my call on Thursday and repeated on Friday that I did not and do not see rocking the boat potential from Bank of Japan policy moves. Living up to expectations, US dollar had started recovering against the Japanese yen, and it had been weakening against the euro. So these have been important clues. For now, when it comes to rate cutting prospects, we are almost to neutral when it comes to the expectations for May rate cut. It's though only July where this one is well over 50% odds that we get a July rate cut. Will Trump get his rate cut and decreasing rates earlier before that? That would that would imply quite a few things. Let's have a look at this bond market overlay. We see continued junk corporate bonds outperformance. We can overlay it as well against S&P 500, and we see that junk corporate bonds are pulling ahead. This is still a risk-on sign, outperforming quality debt instruments. The question is what we had seen on Friday. Did I call for grind up in equities? Yes, I did, leading with S&P 500 and its improving breadth and continued financial leadership, and I had been as well highlighting very much industrials. But grind up needs to be considered in the daily context of the call made, which does not mean going straight up in one line, predictably taking a certain angle in rising without a pullback. We had seen an intraday rejection, and it was facilitated by quite a few aspects when it comes to sectoral and subsectoral performance, which I will dive into in the following charts. But let's follow along this one and the risk sentiment that we are seeing still reigning in equities, and as well we are seeing some signs when it comes to real assets, which I will cover as well. But circling back to the name of this long video is the US dollar. For the first time since the election positioning started early October, we are seeing a distinct reversal and first level of logical support being reached. The question is now, what happens next? Will Trump get his way with lower yields and cooperative oil prices, meaning not just Saudi Arabia turning up the spigots and Russia-Ukraine negotiations leading somewhere, or we will see more of Russian supply trying to be taken off the markets? These are important questions, and if you remember Besant's 333 aspiration, there must be increase in supply in millions of barrels per day coming from somewhere, and that, should it come, would take some pace away from sticky inflation and from the return of inflation that is so painfully obvious when one looks at monthly data and the so long in the tooth disinflation process that I had been covering for a long time. We see, just as well as the Fed does, the sticky inflation, and it's not just forget about the rent component and what real estate is doing, and that it is functioning as a defensive sector at the moment only. Where would we look for signs of risk appetite coming back into the markets and for various assets being positioned in a certain way, either in the direction of US dollar returning to rising and putting a squeeze on the periphery, which is what we would see in, for example, emerging market bonds or in Chinese equities. Where would these signs come from? These are but two of the main ones. Now it's wait and see, as the dollar is at the first support, and we will see the upcoming week what happens. Do I expect a game changer from the Fed? Not really. Look at my doubts about Bank of Japan surprising. Couple of hours after Trump calls for lower yields. Do you think that Powell, who had expressed more than willingness to keep his job, be raising rates or just staying the course in not cutting? Yes, he would not cut, rates would stay the same, and FOMC would pretty much turn out to be a non-event. Let's have a look at two Chinese equity indices. Hong Kong is a bit underperforming, but what we are concentrating on is whether all the stimuli announcements on the mainland Chinese front, that's Shanghai Composite, the black overlaid line, whether these get faded by domestic Chinese investors or not. And I would say that they are in a wait-and-see mode, and they are getting positioned for eventually positive resolution down the road. Timing, that's the trickier part. I think we are more than a couple of weeks away from that, but this is the kind of chart that I would be looking at in conjunction with the US dollar. Should US dollar start slowly drifting lower and euro, which is more sensitive and reacting usually faster to positive liquidity developments and Chinese growth than the United States are, should euro start strengthening and Chinese equities be going up, that would be good sign from the global perspective for risk taking. So that's as well on my radar screen, not just emerging market bonds per se. Now let's go into S&P 500 and this breadth chart. We are seeing lesser willingness to push stock prices higher, and it has quite a few reasons, and it starts with semiconductors. No matter any Stargate initiative, the DeepSeek that I had been tweeting about is, by the way, a genuine game changer. It's open source, it's cheap, and its performance is simply great and only reflects Chinese growing dominance when it comes to applied sciences, and how China is taking the lead and how much the world has changed in the last 10 or 15 years. But we are seeing huge infrastructure push in the States, be it from the energy part, electricity infrastructure, upgrades, giant approval, giant nod towards nuclear energy. We are seeing as well and noticing how well natural gas would be serving as a transition fuel, renewed focus on fossil fuels, and that has consequences for the US part in trying to maintain dominance in the AI space. And here we see that unfortunately Semiconductors had not been able to overcome any of their latest resistances in the last couple of days, and that's part of why S&P 500 is having such a hard time extending gains and rising from the lows of the pre-inauguration correction that I had been talking about since November that is going to be happening. The first catalyst had been December FOMC and the large red candle. S&P 500 is clearly above it, and it has to be thankful for that to financials. And later on, industrials have turned as well. These sectors both made similar undershoots of their support levels that S&P 500 on this chart made shortly before inauguration. So we are seeing these breadth developments, and what has been one of the defining factors Friday, strong risk of composition. We had seen two intraday pushes for all-time highs, and they did not stick, unfortunately. And we had seen outperformance of defensives. The ratio of staples to discretionaries had been wildly in daily favor of staples. Financials had remained barely positive. It was real estate that was driving it, that was seeing inflows, and of course utilities. A little bit as well healthcare did. But the point when it comes to the index is, for all the advanced decline line non-confirmation that we saw Friday, is whether this is a lasting reversal or not. Don't be misled by the S&P 500 or futures volume on Friday. The SPY volume of the ETF had been lower, relatively lower than that of Thursday, and that, in my mind, points, among many other confirming signs, to this being just a very temporary setback which will be worked off and higher highs will be coming. And of course it depends upon whether yields will remain behaved or not. I do not see in this upcoming week a great move in yields either way, and usually this is mildly positive equities. So let's keep that in mind. Financials, they of course fulfilled their expectations Friday. Their earnings are as well very good, and remember that US economy is a fire economy, which means that the role of financials, and these are as well great beneficiaries of the upcoming deregulation, will be greatly emphasized, and this is going to be the sector that is going to be still leading. So the train has nowhere enough left the station. There is still way more gains to come in financials. It's not just wood, it's not just interactive brokers, which I had talked, I think, Thursday. Do yourself a favor, review this week's videos and the market breadth improvements and feeling the pulse on the markets that I've been bringing you. It's been a clear signpost for what is coming And what we had seen unfold during this week, steeper gains, more gains in equities. You remember as well my call given to trading signals clients about precious metals led by gold, and only then later on Friday, before Friday's opening bell, I called for silver to start joining and to keep the relative gains that it had made. But on gold I had been bullish, expecting the yellow metal to shake off the CPI surprise and expecting just a brief dip there and continuing to fresh highs, which was exactly what had unfolded. As for oil, I was not sure how much time it would take for crude to break below the 76 support. There might have been a day or two hesitation more, but it continued lower. And somewhat before Trump's speech in Davos already. So these are as well great benefits to clients that had been served in the last, say, 7 trading days. And these had been covered excuse me, these had been covered in the CPI presentation that had been so well received prior Wednesday. Here you can see it in the sectoral overview. Mild setback in S&P 500 and the leading sectors. When it comes to communications, you heard me as well this week earlier talk Netflix, and you see the defensive bias that is so much present when it comes to Friday and continued financials outperformance. And I'm waiting for the industrial sign when this starts to turn alongside a bit more decent tech showing, because there is apart from semiconductors there are still quite a few decently bright, not reasonably, not very bright, not shiningly bright spots in tech, but there still are. Review Friday's video where I'm diving into what I had been expecting and how I had been making sense for clients about this precious metals chart and why I was expecting gold to swing higher and miners to join and silver as well to finally turn up again. This is similar chart for crude oil the same day going into Friday, and the continuing breakdown. Sectoral leadership very clear. Note the fake breakdown pre-inauguration and continued ripping higher in financials, and this engine will overcome with ease its late November highs. So have that in mind, that we are not going to be seeing S&P 500 roll into a bear market unless financials do that as well. And this chart is readying to swing higher, considerably higher, for macro and fundamental reasons. Industrials, very mild setback, so don't lose courage, don't lose faith, and don't lose big picture orientation, and remind yourself of this chart, how similar it is looking to the prior one in financials. This sector will be going up as well, and that sends a message not just about the dollar, which I do not think, frankly, is finished making a top. This process has to go on for longer because there is still much uncertainty. Remember the China charts that I had been showing you, and open your own emerging market bonds chart to see the indecision at the periphery still. So this is as much as I wanted to say about industrials, and I'm not writing this sector off at all. And the component that would drive it higher would be, should we see, which is what the new US admin clearly wants, preference of growth at the expense of inflation fight. This would come back to bite, but for now yields are behaved, and it depends how many more months we would be getting before the bond vigilantes come back, and when they force yields over 5.25 on the 10-year percentage points. That would be the defining moment when I'm looking for a significant, clear trend change, meaning distinctly corrective phase in S&P 500 hitting. So these are a bit more longer term thoughts inspired by this industrials chart. And now when it comes to chart requests and questions, first solar, I had received, sure, it looks like a nice rising channel, but is this the time of alternative energy, of solar, of clean energy? Out of the three tickers given, PBW is what I like shaping up best. So if I had to be on the long side in anything, that would be the ticker I would be picking, not this one, frankly not. And let's get to crypto, and that's the one of the other clearest risk on or risk off signs. Here in the last couple of days we are seeing a lot of indecision, but as well as what I had told you about S&P 500, this is about a slow grind higher. While before the correction had been reaching 90,000, you remember me covering mid-December the importance of 92,000-93,000 support zone. The low 90s had held, and now in the same function it's 100,000 that is emerging as the new support. And is this a bearish chart or is this a bullish chart? I argue this is still a bullish chart, but it requires still a bit more patience, because here on the overlaid black line we see MicroStrategy, and it has its own specifics coming from the convertibles, redemptions, tax bill, whatever. There is a distinct amount of uncertainty and the willingness to sell into intraday rips. So and at the same time I say it would be misleading to judge Bitcoin based on what MicroStrategy is doing. So don't throw in the towel. Bitcoin just requires more patience, but the support at 100,000 is now clearly there, and it wouldn't take much for it to be overcome. Waiting for signs from global liquidity. Forget not that the Fed is still in a restrictive mode and shrinking its balance sheet. That would be first part of the turn in Fed policy, ending the runoff and not just letting those securities mature without rolling them off. Time will come, and this would happen before any yield curve control comes on the table months later. But this is more than just first half of 2025 idea perspective. For now, we are still in a reasonably restrictive, somewhat restrictive Fed, and this is why Bitcoin is still having trouble to rise, even though we are getting the strategic reserve and plenty of other AI friendly and crypto friendly initiatives. So take your time. Trend is your friend, and this trend is still pointing higher. CLSK is the other one, and it's slowly improving. Is this thought the leader? Same for Mara. Now, instead of these two, put in coin. That one is tracking much better and much closer the Bitcoin price. So again, if I had to be looking for anything where to park money on a medium-term basis, I would not be going CLSK or Mara way, I would be going rather the coin way. So that was it. Thank you for your chart requests. Thank you for liking this video and subscribing to the channel. My join page will help you select what's right for you, including my one-on-one support delivered chiefly over Telegram. Thank you for everything and have a beautiful weekend. Obligatory disclaimer, and let's get ready for the fresh week.